Group 3, and we will be presenting our report for depreciation and depletion and charitable and other contributions.
So furthermore, we're going to be talking about depreciable property. So an allowance for depreciation is limited to property used in the taxpayer's trade or business. So these properties may be tangible products or physical objects. Under depreciation, tangible objects that are subject to wear and tear, to decay or decline from natural causes, to exhaustion and to obsolescence. So an example of this is machinery. So over time, machineries may wear out. So these need to be included in an allowance of depreciation, since machineries may deteriorate over a period of time and may need to be replaced by a new machinery. So next we have here intangible products or objects that are not physical in nature. So under depreciable property, the use of intangible products in the trade or business is definitely limited in duration. So an example of these are patents. Patents need to be amortized, meaning an initial cost of a patent needs to be written off. So a patent is an asset that may need to be adjusted at times to mirror its current market value. That is why it's depreciable. Over here we have assets not subject to depreciation. So the following assets are not subject to depreciation. Number one, we have here inventories or stock in trade. Number two, we have land, except from improvements or physical development added to the land. So those are not depreciated. We have bodies of mineral, which are already subject to depletion allowance, since it goes through the process of removal, suffer depletion. So those are not included depreciation. For number four, we have here automobiles or other transportation equipment, which are used solely for the taxpayer's pleasure. So if it's not used for the business, it is not added to the depreciation. For number five, we have here the building, or specifically a building that is used by the taxpayer as his or her residence. So again, for personal use. And for number six, we have the furniture or furnishing, again, which is used in the taxpayer's residence. Number seven, we have here personal effects or clothing that are not used for a business. So number eight, we have here intangibles, so use of which in business or trade is not of limited durations. And number nine, we have incidental repairs. So incidental repairs are repairs that neither materially add to the value of the property, nor appreciably prolong the life. But, however, this repairs keeps the property in an ordinary efficient operating condition. So next up, we have charging of depreciation. A depreciation allowance, which constitutes an allowable deduction from gross income, must be charged off. So the meaning of charged off is that it's a debt that a company believes it will no longer collect as the borrower has become delinquent on payment. So a depreciation allowance must be charged off according to the following. So number one, we have here manner. So a particular manner in which it shall be charged off is not material. It is the amounts measuring a reasonable allowance for depreciation. It must either be deducted directly from the book value of the assets, or preferably it must be credited to a depreciation reserve account. And this depreciation account must then be reflected in the annual balance sheet. For number two, we have here computation. So the allowance in computation should be computed and charged off with express reference to specific items, units, or groups of property. So each item or unit should be considered separately or specifically included in a group in which the same factors apply. For number three, we have the records. So taxpayers should keep records of each item of depreciable property because this may permit verification of the factors in computing the allowances for each item each year. As for time, number four, in terms of time, the taxpayer should deduct the property depreciation in the year in which the wear and tear occurs. So note this. If depreciation has not been taken in prior years, this does not entitle the taxpayer to deduct in any taxable year a greater amount for depreciation that would be otherwise allowable, because depreciation may not be accumulated. So depreciation must really be deducted upon the time or year in which the loss, injury, or stress to something being used occurs. Next topic we'll be talking about is statement to be attached to return. So when depreciation charges are claimed, to each return there should be attached a statement showing the item, unit, or group of depreciable property, the cost, price of charge, amount previously deducted, and the amount claimed in the return. So this data that is gathered in the statement must agree and appear the same as the information in the books of the taxpayer. Next up, we have here commencement of depreciation. Depreciation begins of the property. So the owner of a property is not bound to see his property gradually waste. He or she must make provision through earnings for its replacement. Furthermore, a property owner is entitled to see that from the earnings, the value invested is kept unimpaired, meaning it's not weakened or damaged, so that the original investment remains as it was in the beginning at the end of any given terms of years. Accordingly, the law permits the taxpayer to recover gradually his capital investment in wasting assets. So this is free from tax. Now let's talk about proper allowance for depreciation. The proper allowance for depreciation of any property used in trade or business is that amount which should be set aside for the taxable year under a reasonable, consistent plan. So the aggregate of the amount set aside plus the salvage value will equal the basis of the property at the end of the useful life of the property in business. So due regard must also be given to expenditures for upkeep. So in this slide, we have an illustration of the calculation of proper allowance for depreciation. And here is the example. So let's say a business has a truck with a cost of 350,000 pesos. The truck's estimated useful life is 6 years, and it has a salvage value of 3,500 pesos. After its useful life, the truck should have a salvage value of 57,750 pesos. So the proper allowance for depreciation is calculated as follows, as you can see here. The cost, which is 350,000 pesos, less salvage cost, which is 3,500. So if you minus the salvage cost to the cost, we will then get the amount subject to depreciation, which is 346,500 pesos. So here below it says, using the straight line method of depreciation, the annual depreciation for the truck will be 346,500 pesos divided by 6 years. It will equal to 57,750 pesos. As said here in the example, that the salvage value should be 57,750 pesos. So that's an example of how you can be able to calculate a proper allowance for depreciation. Now, let's go to the basis for depreciation. The cost or other basis of the property for which the allowance is made is the capital sum that will be replaced by depreciation allowances. This means that property that has been amortized to its scrap value and is no longer in use cannot be deducted from depreciation. Now, what about deductions limited to capital invested? Our law allows depreciation to be deducted from gross income, but it only recovers the capital invested in the assets being depreciated. This means that assets cannot be depreciated beyond their initial purchase price. So in order to visualize this better, let's have an example. Kim bought a motorcycle for his business for 70,000 pesos. Because the motorcycle is now an asset to Kim and his business, it can only be depreciated below 70,000 pesos, which is the initial price that Kim spent to purchase it. This is due to the fact that deductions are a privilege rather than a right. They are not established by implication, but rather by the explicit expression of law. Now, let's have another example, this time from Leon's book. Julio deducted 47,342 and 53 centavos from the depreciation of one of his assets in 2005 because of the increased replacement cost. The same asset had also been depreciated by only 36,842 and 4 centavos last year, and Julio determined its value based on the cost of acquisition. Next is the depreciation of intangible property. But first, let us repeat its definition as stated earlier. Tangible property basically means an owned asset without a physical existence. Its depreciation can be determined by the following. First, intangibles, the use of which in the business is definitely limited in duration, may be the subject of a depreciation allowance, and these include patents, copyrights, and franchises. Second, intangibles, the use of which in the business or trade is not so limited, will not usually be a proper subject of such an allowance. Third, a depreciation allowance may be granted for an intangible asset that was acquired through capital outlay if it has been established through experience that it will only be a value to the business for a limited period, the length of which can be estimated from experience with reasonable certainty, provided that the facts are fully demonstrated and the return or prior thereto to the satisfaction of the Commissioner of Internal Revenue. Speaking of patent and copyright, what about their depreciation? First, computation. In order to compute a depreciation allowance in the case of a patent or copyright, the capital sum to be replaced is the cost or other basis of the patent or copyright. Second, how about if it's acquired from the government? The various government fees, the cost of drawings, experimental costs, models, attorney's fees, development costs, etc., make up the cost of the patent or copyright if it was obtained from the government. Third, fair market value or basis. A patent can only be depreciated based on its fair market value as of March 1, 1913, if sufficient and affirmative evidence of this value is presented. What if the patent becomes obsolete? If the patent becomes obsolete prior to its expiration, the commissioner may specifically grant permission to dedicate a portion of the depreciation that is based on the number of years remaining in the patent's life to the total number of years between its basic expiration date and that date. Fifth, where depreciation is not deducted. The taxpayer cannot deduct more depreciation than would otherwise be allowed in any taxable year because depreciation has not been taken in previous years. Sixth, terms of patent. According to the Intellectual Property Code, a patent is valid for 20 years from the application's filing date. Let's cite another illustration from De Leon. A corporation developed and invented a machine which produces a special product. The cost of development and research with the government and attorney's fees on the new invention is 34
corporation is on the calendar year basis. This is how we will compute it. For 2019, we will be dividing the cost of rent by its term of payment. So it will be 34,000 pesos divided by 20 years, which is then 1,700 pesos. Now we will be multiplying 1,700 pesos by 3/4. The application for the patent was filed on April 1st, which is the first quarter of the year. Now the answer then would be 1,275 pesos, which is then the amortization of the patent for 2019. Now for 2020, it is the same process. However, we will not be multiplying it by 3/4 because we are looking at the whole year. So for the amortization of year 2020, it will be 1,700 pesos. Lastly, for the depreciation of patent or copyright, the duration of copyright. Now, copyright is protected during the author's lifetime and for 50 years after his death, subject to the provisions of sections 213.2 to 213.5 of the Intellectual Property Code. Posthumous works also fall under this rule. If the period of usefulness of any such asset can be estimated from experience with reasonable accuracy, it may be subject to the depreciation allowances spread out over that estimated period of usefulness when a taxpayer has incurred expenditures in his business for designs, patterns, models, or experimental work that are calculated to improve his facilities or his product. Second is the proof. In order to satisfy the commissioner, the facts must be fully demonstrated in the return or prior to it. A taxpayer cannot deduct any amount that has been set up as an asset, with the exception of these depreciation allowances, unless the asset is sold or otherwise disposed of at a loss, or there is an evidence of a total loss. Here's another illustration by De Leon. The SureFit Shoes Corporation spent 10,000 pesos and 20,000 pesos for a shoe pattern for both men's and ladies' shoes, respectively. The company, based on experience, depreciates men's shoe patterns for 8 years and only 4 years for the ladies. The company is allowed a total yearly depreciation of 6,250 on these patterns, computed as follows. So men's shoe pattern is 10,000 pesos divided by 8 years, which is the depreciation years, which is then 1,250 pesos. Now for the ladies, 20,000 pesos divided by 4 is 5,000 pesos. And if we add them all up, the company depreciates a total of 6,250 pesos.
So let's proceed to the next topic, methods of computing depreciation allowance. Any method of depreciation may be used, provided it is reasonable and must have due regard to operating conditions during the taxable period. Some of the most common forms employed are the first one, straight line method. This method spreads the total depreciation over the useful life of the asset. So in here, it calculates how much a specific asset depreciates in 1 year and then depreciates the asset by that amount every year after that. So the formula is cost or other basis less scrap value, if there is any, over its estimated useful life equals annual depreciation. So here we have an illustration. The cost of a machine is 10,000 pesos with an estimated useful life of 5 years with no salvage value at the end of 5 years. Under this method, the annual depreciation charge is computed as follows. So based on the formula, we have distributed the cost of a machine, which is 10,000 pesos over its estimated useful life, 5 years, equals 2,000 pesos. So this is how straight line method works. So let's proceed to the second one, which is the declining balance method. This method uses a rate, usually 1.5 or 2 times the straight line rate, to the declining book value of the asset. So in here, where assets are depreciated at a higher rate in the initial years than in the subsequent years, under this method, a constant depreciation rate is applied to an asset's declining book value each year. This method results in accelerated depreciation and higher depreciation value in the early years of life of an asset. So in here, the formula is as follows. 1 over its estimated useful life times 2 or 1.5, which is the rate, equals its rate. So the book value times rate will be resulted into depreciation expense. So we have here an illustration. A machine costing 10,000 pesos is to be depreciated in 5 years. The yearly depreciation expense using the declining balance method is computed as follows. So here we have the rate. 1/2 times 2 equals to 40%. So in the data below, we have the year, 5 years, the computation, the accumulated depreciation from the computation, also the book depreciation, and the value. Next, we have working hours method. In computing depreciation under this method, the total working hours of the machine until its retirement is estimated and the charge per hour is determined under these formulas. So we have here the cost per other basis, less scrap value, if there is any, over its estimated useful life in hours equals depreciation charge per hour. And next, we have the number of hours asset was used during times depreciation charge per hour equals annual depreciation. So here we have an illustration. Assume that a machine which costs 100,000 pesos could be used for an estimated 50,000 hours. In 2019 and 2020, the machine was used for 2,500 hours and 3,000 hours respectively. So the depreciation charges for the said years are computed as follows. So here we're just going to distribute the cost, which is 100,000 pesos, divided by its estimated useful life in hours, which it resulted to 2 pesos. So here in the year 2019, we have 2,500 hours times its depreciation charge per hour, 2 pesos, equals to 5,000 pesos. So in the year 2020, we have 3,000 hours times the depreciation charge per hour, 2 pesos, equals to 6,000 pesos, which is its annual depreciation. So
this is how working hours method works. This is the unit of production method. This method is similar to the working hours method with the difference that the estimated service life is stated in units of products instead of working hours. So here is the following formula may be used. The cost or other basis less scrap value if there is any over its estimated units asset can produce during its life equals its depreciation charge per unit. And the number of units produced during the year and the depreciation charge per unit equals annual depreciation. So here is an example of the illustration. Machine costing 20,000 pesos could be operated to produce an estimated 200,000 units of a product. In 2019 and 2020, the machine produced 10,000 and 15,000 units respectively. So the computation of the depreciation expense for the 2-year period follows. So we're just going to distribute the cost, which is the 20,000 pesos, over its estimated life of the unit, which is the 200,000, equals 0.10 pesos per unit charge. So in the year 2019, we have 10,000 units times 0.10 pesos equals 1,000 pesos, which is the annual depreciation. So same goes with the 2020, 15,000 units times its per unit charge, which is the 0.10 pesos equals 1,500 pesos each annual depreciation. So that's how unit of production method works. Same goes with working hours method process. So let's proceed to the last one, which is the sum of the years digits method. This is a method of depreciation where bigger depreciation expenses are provided during the early years of the fixed asset, which gradually diminish until the total depreciation is equal to the cost of the asset. It is the same as the declining method. So the formula is the number of remaining years of life of asset over its sum of the numbers of each of remaining years of life of asset times the cost or other basis, less scrap value if there is any, and it is equals to annual depreciation. So here we have an illustration, a machine costing 60,000 pesos and with an estimated service life of 3 years would be depreciated as follows under this method. So here, letter A, add the numbers which consist of the periods of life of the asset as follows. So since we have 3 years, we're just going to add the 1 plus 2 plus 3 equals 6. So here in the second process, use the sum obtained 6 as the denominator and use the number consisting of the period of life of the asset in inverse order as the numerator as follows. So the result of letter A, we're just going to distribute the 6 into denominators. We're just going to put the 3, 2, 1 as the numerator since it is 3 years. So let's proceed to the last process. After doing the letter A and B, we should multiply the cost or cost less salvage value by the fraction thus produced. So in the first year, we have here 3 over 6 times the 60,000 pesos, which is the cost of the machine, and it resulted to 30,000 pesos. In the second year, we will just do the same process. 2 over 6 times 60,000 pesos equals to 20,000 pesos. Same goes with third year. 2 over 6 times 60,000 pesos equals to 10,000 pesos. So after that, we will just going to add all the result. And we have a total here 60,000 pesos. So that's how the sum of the years digits method works.
Adjustments for depreciation. It may develop that the useful life of the property will be longer or shorter than the useful life was originally estimated under all the known facts. In such case, the portion of the cost or other basis of the property not already provided for through depreciation allowances should be spread over the remaining useful life of the property as well estimated in the lights of subsequent facts, and depreciation deductions taken accordingly. So here is a sample problem. ABC Corporation has been depreciating its building with a cost of 1 million pesos for 10 years up to the previous year for 20,000 pesos a year. An estimate by an independent appraiser revealed that the building would last for only 20 years, starting on January 1 of the current year. To solve the problem, you need to compute the annual depreciation based on the revised estimated life. So cost less accumulated depreciation, we have 1 million pesos less 200,000. So we will be having a book value of 800,000 pesos. Next is the computation of revised annual depreciation, book value divided by re-estimated life. 800,000 divided by 20 years equals to 40,000 pesos. Agreement as the useful life on which depreciation rate is based. Where under rules and regulations prescribed by the Secretary of Finance, the taxpayer and the Commissioner of Internal Revenue have entered into an agreement specifically dealing with the useful life and depreciation of any property. The rate agreed upon shall be binding on both the taxpayer and the national government in the absence of facts and circumstances not taken into consideration in the adoption of such agreement. The responsibility of the establishing the existence of such facts and circumstances shall rest with the party initiating the modification. In addition, any changes in the agreed rate and useful life of the depreciable property shall not be effective for taxable years prior to the taxable year and which notice in writing by certified or registered mail is served, the party initiating such change to the other party to the agreement. Deduction for obsolescence. So there are two conditions. First one, when allowed. If the whole or any portion of physical property is clearly shown by the taxpayer as being affected by the economic conditions that will result in its being abandoned at a future date prior to the end of its natural life, so that depreciation deduction alone will be insufficient to return the cost or other basis at the end of its economic term of usefulness. A reasonable deduction for obsolescence in addition to depreciation may be allowed. The second condition,
Limited to property affected. This allowance will be confined to such portion of the property affected on which obsolescence is definitely shown to be sustained and cannot apply to the entire property unless all portions thereof are affected by the conditions to which obsolescence is found to be due.
So we're moving on to depletion. Depletion by definition is the exhaustion of natural resources like mines and oil or gas, result of productive severance from such mines or wells. Theory and purpose of depletion allowance. As the product of the mine is sold, a gradual sale is being made if the taxpayer's capital incurs in the property. Depletion allowance enables the taxpayer to recover that capital incurs free tax at its cost or some other basis. First, depletion allowance. Annual depletion deductions are allowed only to mining entities which own an economic interest in mineral deposits. An economic interest is possessed in every case in which the taxpayer has acquired by investment any interest in mineral and placed and secures by any form of legal relationship such as but not limited to operating agreement and service contract agreement, income derived from the extraction of mineral to which it must look for return on its capital. Methods of depletion. There are two methods, cost depletion and percentage depletion. Cost depletion is one of two accounting methods used to allocate costs of extracting natural resources such as timber, minerals, and oil, and to record those costs as operating expenses to reduce pre-tax income. The formula for cost of depletion is APV over TR times U, where APV is adjusted property value, TR is total reserves, and U is units extracted in given period. For percentage depletion, it is a tax deduction for depreciation allowable for businesses involved in extracting fossil fuels, minerals, and other non-renewable resources from the earth. Allowable cost depletion allowance. The allowable statutory percentage depletion deduction is the lesser of net income for 15% of gross income. If net income is less than 15% of gross income, the deduction is limited to 100% of that net income.
Limitations for allowable cost depletion. So the limitation of using cost depletion can only be used for natural resources, such as minerals, oils, and gas well. Cost depletion is based on the usage and must be calculated every period. The first one is exclusion. Amount recoverable through depreciation, through deferred expenses, and through deductions other than depletion are excluded. Also, the residual value of improvements at the end of the operation is also excluded. Second, market value of mining property. The market value shall mean the actual market of the annual gross output of the minerals or minerals extracted or produced from the particular mining property. So the last one is the capital invested in property. The allowable cost depletion deduction shall be limited only to the extent of the capital invested in the particular mining property. Accumulated exploration and development of the same mining area shall also include the following. Number 1, increase the value of the mine. 2, decreases the cost of production of mineral units. And 3, restore property to its previous condition or making exhaustion for which an allowance or has been made. So the next one is the manner of computation of cost depletion. In calculating the cost depletion requires 3 steps. The first one is to estimate the number of units or determine the total amount of extractable resource, such as tons of ore, barrels of oil, board feet of timber, etc. that makes up the deposit. The second one is determine the total investment in the property that is allocable to the extracted resource and divide it by the number of units from step 1 to determine the cost depletion per unit. The next one is multiply the cost depletion per unit by the number of units extracted and sold during the year to determine the cost depletion for the year. Example, a coal mining firm has purchased mineral rights for $10 million and spent an additional $2 million to develop the property. The firm expects to extract 500,000 tons of coal, so based on this information, the depletion rate will be $12 million divided by 500,000 tons, which equals to $24 per ton. In the most recent period, the company extracted 1,000 tons, for which the related depletion expense is $24,000. So the purpose of cost depletion only applies to taxpayers who have economic interest in mineral deposits for purposes of percentage depletion. Determination of mineral content of deposits remaining as of the taxable year. The mineral content of deposits remaining as of the taxable year pertains to the estimated mineral products reasonably known or on a good evidence believed to have existed in place as of the end of the taxable year. The estimate or determination of which was made according to the method current in the industry and in the light of the most accurate and reliable information obtainable. In order to compute depletion allowance for the taxable year, the estimated mineral products remaining as of the taxable year shall include both quantity and grade. And as to quantity, only the case there are extensions of known deposits or new bodies and masses whose existence is indicated by the geological surveys or other evidence of the higher degree of probability. And as to grade, only in accordance with the best indications available as to richness. Accelerated deduction of exploration and development expenditures. Who may avail? All taxpayers involved in mining activities are eligible for accelerated deductions for exploration and development costs, with the exemption of those related to exploration and production development. Election to accelerate deduction. The taxpayer may elect to deduct exploration and development expenditures accumulated as cost or adjusted basis for cost depletion as of date in prospecting and those paid or incurred during the taxable year. The manner of making the election. The election shall be made by clear indication on the written statement to the Commission not later than the due date of filing the return. Basis of deductions. The basis upon accelerated deduction is to be allowed in the total exploration and development expenditures paid or incurred during the taxable year and accumulated as of January 1, 1978 or the first day of the taxable year. The effect of making the election. The option to accelerate deduction of development expenses once exercised shall be irrevocable and binding in succeeding taxable years. But on the other hand, if the taxpayer does not exercise the option, it may continue such development expenses, which will be taken into account from resulting abandonment. The limitation of accelerated deduction. The allowable accelerated deduction for development expenditure shall not exceed 25% of the net income from the mining operation without the benefit of any tax incentives under the existing laws. Second, the basis shall not apply to expenditures for acquisition or development of the property which subject to the allowance for depreciation. And lastly, any amount as a deduction in computing is taxable income during
the yield shall not no longer taken into consideration in computing the adjusted cost.
So next is charitable and other contributions. What is charitable contributions? It is a donation or gift made to or for the benefit of an approved organization is referred to as a charitable contribution. It is given voluntarily and without any expectation of receiving something of equal value. So there are two kinds of charitable contributions. First is ordinary and second is special. So ordinary, these are charitable contributions subject to limitation as to the amount deductible from gross income. Special, these are charitable contributions deductible in full from gross income. Requisites for deductibility of charitable contributions. First, the contribution must actually be paid or made to the Philippine government or any political subdivision thereof or the domestic corporation of or association specified by the tax code. Number two, or second, contribution must be made within the taxable year. And third, the contribution must not exceed 10% of the individual's taxable income and 5% of corporation's taxable income before deducting the contribution. And lastly, the contribution must be supported by adequate records or receipts. Deductible contributions. These contributions or gifts are deductible for the use of the government of the Philippines or any of its agencies or political subdivision exclusively for public purposes. And another thing, it is accredited domestic corporation or associations organized and operated exclusively for specific purposes. So first is religious purpose. Religious purpose refers to promotion, propagation, and accomplishment of any form of religion, creed, or religious belief recognized by the government of the Republic of the Philippines. Next, we have charitable purpose. It refers to extending relief to the poor, distressed, and underprivileged, and also those fighting against juvenile delinquency and community deterioration. Next is scientific and research purpose. It refers to undertaking or assisting in pure or basic applied scientific research in the field of agriculture, forestry, fisheries, industry, engineering, energy development, food and nutrition, medicine, environment and biological, physical and natural sciences for the public interest. So this research or basic research shall refer to an experimental or theoretical work undertaken primarily to acquire new knowledge of the underlying foundation, phenomena, and observable facts without any particular application or use in view. It analyzes properties, structure, or relationships with a view of formulating and testing hypotheses. Results of basic research are not generally sold, but are usually published in scientific journals or circular to interested colleagues. Also, applied research shall refer to an original investigation undertaken in order to acquire new knowledge. And scientific research will be regarded as carried on for public interest if the results of such research are made available to the public on a non-discriminatory basis, or if such research is performed for the government of the Philippines or any of its agencies or political subdivisions, or if such research is directed to the benefit of the public. Applied research develops ideas into operational form. Next, we have youth and sports development purpose. It refers to the character building and includes conducting basic and applied research on youth development. It initiates and establishes youth organizations to promote and develop youth activities, including the establishment of summer camps or centers for leadership training, conducting a program on physical fitness and amateur sports development for the country, developing and maintaining recreational facilities, playgrounds and sports centers, and conducting training programs for the development of youth and athletes for national and international competitions. Next purpose is cultural. Cultural activity refers to undertaking or assisting in research activities on all aspects of history, social systems, customs and traditions, developing, enriching, and preserving Philippine arts and culture. It also develops and promotes the visual and performing arts and participating in vigorous implementation of bilingual policy through translation and wider use of technical, scientific, and creative publication. It develops an adaptive technical dictionary and use of Filipino as the medium of instruction. Next is educational purposes. So these are educational activity that refers and includes granting of scholarships to the serving students and professional chairs for the enhancement of professional courses and instructing or training of individuals either through formal and informal methods. So there are two methods of educational activity. First is formal method. It is an instruction that refers to the institutionalized, chronologically graded, and hierarchically structured educational system at all levels of education. While non-formal method of instruction refers to any deliberately organized, systematic educational activity carried and outside the framework of the formal system to provide selected types of learning to particular subgroups of the population, particularly of school youths and adults, for the purpose of communicating ideas, developing skills, changing attitudes, or modifying behavior, or to improve their character and to provide them with tools necessary for achievement of a higher standard of living. So lastly, rehabilitation of veterans. This purpose includes services extended to Philippine veterans and members of their families because of financial difficulties and attendant problems, and services extended to disabled veterans towards product. So another thing to consider is social welfare and purposes. This refers to undertaking and assisting in amelioration of the living condition of distressed citizens, particularly those who are handicapped by reasons of poverty, youth, physical and mental disability, illness, old age, and natural disasters, including assistance to cultural minorities. And also pursuing a program for the protection and development of children and youth, such as providing services for dropouts, preschool students of low-income working mothers, and physically handicapped children. And one more thing to consider is to provide for rehabilitation for the youth and disabled adults, release prisoners, drug addicts, alcoholics, mentally retarded, and similar cases. And lastly, providing for services to squatter families and to disabled workers.
Valuation of contributions means the value of a company asset contributed by a member to the company. Net of liability secured by such contributed asset that the company is treated as assuming or taking subject to. Contributions deductible in full. In most cases, the amount of charitable cash contributions taxpayers can deduct on Schedule A as an itemized deduction is limited to a percentage. Usually 60% of the taxpayers' adjusted gross income (AGI). Qualified contributions are not subject to these limitations. Individuals may deduct qualified contributions of up to 100% of their adjusted gross income. A corporation may deduct qualified contributions of up to 25% of its taxable income. Contributions that exceed that amount can carry over the next tax year. To qualify, the contribution must be a cash contribution made to a qualifying organization or made during the calendar year 2020. Deductibility of donations. You may deduct charitable contributions of money or property made to qualified organizations if you itemize your deductions. Generally, you may deduct up to 50% of your adjusted gross income, but 20% and 30% limitations apply in some cases. Manner of calculation. In general, you are only permitted to deduct up to 60% of your adjusted gross income (AGI), while there are specific circumstances where 20%, 30%, or 50% limitations may be in effect.
Accreditation as a prerequisite as a donor institution under the tax code. Non-governmental organizations must be accredited by the accredited entity. designated by the Secretary of Finance. Formalities required. All accredited non-stock non-profit corporations and non-government organizations should issue a certificate of donation in such form prescribed by the DIR on every donation or gift they receive. Proof of deduction. Contributions of gifts shall be allowed as deduction if verified under rules and regulation prescribed by the Secretary of Finance. Right of taxpayer to prove contribution without receipt. The administrative requirement cannot deprive the taxpayer of his right to prove his contribution. The administrative requirement of the donor to submit the records or pieces of evidence in lieu of official receipts, or known as OR, to substantiate the claim for deduction on donation.
All right, hello everyone. My name is Francine, and I will be reporting about research and development. So, in general, a taxpayer may treat research or development expenditures paid or incurred by him during the taxable year in connection with his trade, business, or profession as ordinary and necessary expenses, which are not chargeable to capital account. The expenditures so treated shall be allowed as deduction during the taxable year when paid or incurred. The amortization of certain research and development expenditures. First, option to amortize and period irrevocable. As a rule, research and development expenditures may be treated as ordinary and necessary expenses and deducted during the taxable period when they were incurred. However, the tax code gives the taxpayer the option to defer or amortize these expenses over a period of not less than the 60-month minimum period provided. Both the option and the period shall be irrevocable and can be changed only with the approval of the commissioner. Amortization will be preferred by a company when little revenue against which the expenses can be deducted is expected in the initial years. On the other hand, outright deduction of the expense is advisable if the taxable revenue will materialize within a period shorter than the minimum period. Second, expenditures treated as deferred expenses. At the election of the taxpayer and in accordance with the rules and regulations to be prescribed by the Secretary of Finance upon recommendation of the Commissioner, the following research and development expenditures may be treated as deferred expenses with the A, paid or incurred by the taxpayer in connection with his trade, business, or profession, B, not treated as ordinary and necessary expenses, and C, chargeable to capital accounts but not chargeable to property of a character which is subject to depreciation or depletion. In computing taxable income, the deferred expenses will be allowed as deduction ratably distributed over a period of not less than 60 months, as may be elected by the taxpayer, or beginning with the month in which the taxpayer first realizes benefits from such expenditures. Third, time for making election. The election by the taxpayer may be made for any taxable year beginning January 1st, 1998, but only if made not later than the time prescribed by law for filing the return for such taxable year. The method so elected and the period selected by the taxpayer shall be adhered to in computing taxable income for the taxable year for which the election is made and for all subsequently taxable years unless with the approval of the Commissioner. A change to a different method is authorized with respect to a part or all of such expenditures. The election shall not apply to any expenditure paid or incurred during any taxable year prior to the taxable year for which the taxpayer makes the election. For the first example and illustration, ABC Corporation has been incurring research and development expenses for the development of its new jelly products. The corporation, on January 1st, 2018, decided to defer its research and development costs and amortize the cost in 60 months. The table below shows the research and development cost paid for each year. In 2019, 50,000 pesos was paid. In 2020, 60,000 pesos was paid. So what we need to look for is the deferred and amortized portion of ABC Corporation's research and costs. The table below shows that in 2019, the deferred is none, and their expenses is 50,000 pesos. For 2020, the deferred is 48,000 pesos, and expenses are 12,000 pesos. So of course, there are limitations on deduction. The rules do not apply to 1. Any expenditure for the acquisition or improvement of land or for the improvement of property to be used in connection with research and development of a character which is subject to depreciation and depletion. And 2. Any expenditure paid or incurred for the purpose of ascertaining the existence, location, extent, or quality of any deposit of ore or other mineral, including oil or gas.
Good day, everyone. My name is Princess CJP Padin, and together with me is Corel May Republican. We will be tackling about pension trust. So what is a pension trust? Pension trust, also called a superannuation fund in some countries, is a fund established to hold the contributions, income, and assets of a retirement system or plan in public trust. It is where they collect money from employers and employees to fund employee retirement obligations. Pension fund providers look to long-term growth of capital to support the needs of future retirees as the cost of living increases over their working lives. So the general rule of pension trust is that an employer establishing or maintaining a pension trust to provide for the payment of reasonable pensions to its employees is allowed to deduct, number 1, present service contributions or contributions to trust during the taxable year to cover the pension liability accruing during the year, and number 2, past service contributions or contributions of a reasonable amount transferred or paid into such trust during the taxable year in excess of the present service contributions, but only if such amount is A, has not been allowed as a deduction, and B, if it is apportioned in equal parts over a period of 10 consecutive years beginning with the year in which the transfer or payment is made. So what are the requisites for deductibility of payments to pension trust? Number 1, the employer must have established a pension or retirement plan to provide for the payment of reasonable pensions to its employees. Number 2, the pension plan is reasonable and actuarially sound. Number 3, it must be funded by the employer, that is, the employer contributes cash to the plan. Number 4, the amount contributed must no longer be subject to its control or disposition. Number 5, the payment has not been allowed before as a deduction. And lastly, the amount is apportioned in equal parts over a period of 10 consecutive years beginning with the year in which the transfer or payment is made. So the payments to employees' pension trust which are deductible are, number 1, amounts contributed by the employer during the taxable year into the pension plan to cover the pension liability accruing during the year. Payments under this are considered as ordinary and necessary business expenses, allowed as deductions. Number 2, 1/10 of the reasonable amount paid by the employer to cover pension liability applicable to the years prior to the taxable year or so are paid to place the trust in a sound financial basis. The payments under this is the payment to the pension trust, which is deductible from gross income pursuant to Section 34J of the Tax Code. So to give an example, ABC Corporation, manufacturer of doormats, which was incorporated years ago, established qualified pension plan for its employees and appointed XYZ Insurance Company as trustee to administer the plan. The corporation paid to the trustee 50,000 pesos to cover pension of employees for past services from the time it was organized up to the establishment of the pension plan. Under the plan, the corporation has to pay to the trustee 20,000 pesos a year. The solution for the amount deductible is computed as follows. The amount paid during the taxable year is 20,000 pesos. We will then get 1/10 of the amount paid to cover past services of employees. So 50,000 pesos divided by 10, we will then get 5,000 pesos. The total amount deductible would then become 25,000 pesos. After 10 years, the amount deductible would only be the amount paid for the taxable year because after 10 years, the 50,000 pesos shall have been amortized.
In the second problem, the Cosmopolitan Bank, incorporated in 1981, put up a qualified retirement plan for its employees. It appointed its trust department to administer the plan. The actuarial report on the plan called for payments to be retirement of employees for past services rendered. The bank must also contribute 400,000 pesos per year to the plan. It paid these amounts to the trustee for the first 3 years of the plan's operation. For the previous 3 years' services, the bank contributed 750,000 pesos in the first year, 500,000 in the second year, and 250,000 pesos in the third year, while the bank's current contribution for 3 years is 400,000 pesos each year. So we are required to compute for the deductible pension expense of the Cosmopolitan Bank for the 3 years of the plan's operation. Solution to problem number 2. The current contribution is 400,000 pesos each year. From the previous slide, number 2 rule of payment deductible is to deduct the 1/10 of the gross income of the employee. Therefore, we will deduct 10% of the gross income of the employee. 10% of 750,000 is 75,000, which the bank contributed for the past 3 years of services. 10% of 500,000 is 50,000, of which the bank has contributed in the past 2 years. And for the third year, 10% of 250,000 is 25,000 pesos, as in the last year. And that gives us the total deductions of 475,000 pesos in the first year, 525,000 for the second year, and 550,000 pesos in the third year. Private Retirement Benefit Plan. Under RA number 4917, retirement benefits received by employees of private firms under a reasonable private benefit plan maintained by the employer are exempt from all taxes. provided that the retiring employee has been in the service of the same employer for at least 10 years and is not less than 50 years of age at the time of his retirement. The law further provides that the term reasonable private benefit plan means a pension, gratuity, stock bonus, or profit sharing plan maintained by an employer for the benefit of some or all of his employees, wherein contributions are made by such employer or employees for the purpose of distributing to such employee the earnings and principal of the fund thus accumulated. And second, wherein said plan provides that at no time shall any part of the principal or income of the fund be used for or be diverted to any purpose other than for the exclusive benefit of said employees. The following are the requisites of a reasonable retirement benefit plan. First, it must be a definite written program setting. Fourth, all provisions essential for qualification. Second, it must be permanent and continuing program unless sooner terminated by virtue of a valid business reason. Third, it must cover at least 70% of all officials and employees. If the plan provides eligibility requirements and at least 70% of all officials and employees meet the eligibility requirements, at least 80% of those eligible must be covered. Fourth, it must provide for the non-diversion of the corpus or income of the trust fund to any purpose other than for the exclusive benefit of officials and employees. Fifth, it must not provide for discrimination in contributions or benefits in favor of officials and employees who are officers, shareholders, supervisors, or highly compensated officers. Sixth, it must provide for the contribution to the trust fund by the employer of officials and employees, or both for the purpose of distributing to the officials and employees or their beneficiaries the corpus and income of the fund accumulated by the trust in accordance with the plan. And lastly, it must provide for non-forfeitable rights, that is, upon the termination of the plan or upon the complete discontinuance of contributions under the plan. The rights of each official or employer to benefits accrue to the date of such termination, to the extent then funded, or the rights of each employer to the amounts credited to his account at such time are non-forfeitable.
So these are the options available to taxpayers. First is individual, second is domestic corporation and resident foreign corporation, and lastly the third is general professional partnership and the patterns comprising such partnership. So what is individual? In the form of the itemized deductions, an individual subject to income tax other than one with pure compensation income and a non-resident alien may elect a standard deduction in an amount not exceeding 40% of his gross sales or gross receipts, except when the commissioner otherwise permits. The individual shall keep such records pertaining to his gross sales or gross receipts during the taxable year, as may be required by the rules and regulations promulgated by the Secretary of Finance upon recommendation of the Commissioner, can be defined in Section 34 and IRC as amended by Republic Act Number 9504. On the other hand, domestic corporations and resident foreign corporations may elect a standard deduction in an amount not exceeding 40% of gross income. And lastly, a general professional partnership and the individuals comprising such partnership may avail of the optional standard deduction only once, either by the general professional partnership or the partners comprising the partnership. Gross receipts refer to the total amount of money or its equivalent representing the contract price, compensation, service fee, rental, or royalty, including the amount charged for materials supplied with the services, and deposits and advance payments actually or constructively received during the taxable period for the services performed or to be performed for another person, except returnable security deposits. In the case of VAT taxpayer, this shall exclude the VAT component. On the other hand, gross sales refer to the total sales transactions net of VAT, if applicable, reported during the period without any other deduction. However, gross sales subject to the 8% income tax rate option shall be net of these deductions. First is sales returns and allowances for which a proper credit or refund was made during the month or quarter to the buyer for sales previously recorded as taxable sales. And secondly, the discounts determined and granted at the time of sale, which are expressly indicated in the invoice. The amount thereof forming part of the gross sales duly recorded in the books of accounts. Sales discount indicated in the invoice at the time of sale, the grant of which is not dependent upon happening of future event, may be excluded from the gross sales within the same month or quarter it was given. And lastly, gross income is determined by deducting the cost of sales or services from the gross sales or gross receipts.
Other implications of the optional standard deduction. There are key implications which applies in an OSD. For instance, a taxpayer who elected to avail of the optimal standard deduction, not exceeding 40% of gross sales or gross receipts. In case of an individual, taxable under sections 24A and 25A1, or 40% of gross income. In case of corporation subject to tax under section 27A or 28A1, shall signify in his or its return such intention. Otherwise, he or it shall be considered as having availed himself of the itemized deductions allowed under section 34. To continue, no deductions shall be allowed to individual taxpayers earning compensation. These are incomes arising from personal services rendered under an employer-employee relationship, and those who opted to be taxed at 8% income tax rate, and their income from business or practice of profession. OSD must be signified in the income tax return by checking the appropriate box in the income tax return. Unless the taxpayer signifies in the income tax return the intention to elect the OSD, it shall be considered as having availed of the itemized deductions. Once the election is made, it must be consistently applied to all the succeeding quarterly returns and in the final income tax return for the taxable year. Such election of the option, when made in the return, shall be irrevocable for the taxable year for which the return is made. The third, OSD allowed to individual taxpayers, except non-resident aliens, shall be 40% of gross sales or receipts during the taxable year. An individual entitled to and claim the OSD shall not be required to submit with the tax return such financial statements otherwise required under the tax code. So the following problems will help illustrate the computation of an OSD. So problem number 1, Miss RPSV is a prominent independent contractor who offers architectural and engineering services. Since RPSV's career flourished, her total gross receipts amounted to 4,250,000 pesos for taxable year 2018. Her recorded cost of service and operating expenses were 2,150,000 pesos and 1 million pesos respectively. She opted to avail of the 40% OSD. So to compute for the OSD, we simply had to multiply the OSD rate of 40% to the gross receipts, which will give us a product of 1,700,000 pesos, 700,000 pesos rather, which will be the deductible OSD. Now for the net taxable income, we simply had to deduct the OSD from the gross receipts, which would give us a net taxable income of 2,550,000. Now for income tax liability, it will be computed that on 2 million pesos, it will be 490 pesos. On excess, 2,550,000 minus 2 million pesos, which then will be multiplied by 32%. And the product of that would be added to the first one, which is 490,000 pesos, plus 176,000 pesos, which will then give you the income tax due of 666,000 pesos. Now, the individual taxpayer elected OSD in the computation of her taxable income, and the election is irrevocable for the taxable year for which the return was made. Taxpayer is not required to submit her financial statements with her tax return. However, the gross receipts exceeded the VAT threshold of 3 million pesos. Thus, the taxpayer is subject to the graduated income tax rate and liable for VAT, in addition to the income tax. Now for problem number 2, Ms. MRU operates a convenience store while she offers bookkeeping services to her clients. In 2018, her gross sales amounted to 1,800,000 pesos. In addition to her gross receipts from bookkeeping services of 400,000 pesos, her recorded cost of goods sold and operating expenses were 1,325,000 and 320,000 respectively.
So special deductions, special rule for deductions. Tax code provides special rules for deductions for gross income for these entities: insurance companies, mutual insurance companies, mutual marine insurance companies, assessment insurance companies, estate and trust, and private education institutions.
Insurance companies. Insurance companies, whether domestic or foreign, doing business in the Philippines are allowed to deduct in addition to the following itemized deductions under Section 34 of the tax code. The following are: 1. Net additions, if any, required by the law to be made within the year to reserve funds, and some other than dividends paid within the year on policy and annuity contracts. The released reserve shall be treated as income for the year of release. So, illustration 1 shows that 2018 there is 120 million in reserve, then increased by 1 million in the next year, then decreased by 1,500,000 the next year. So the journal entry should be in the 2018 to 2019 is debit increase in liability reserve by 1 million, credit liability reserve. In 2019, the decrease to 2020 is 1,500,000. The journal entry should be debit liability reserve 1,500,000, credit decrease in liability reserve. Mutual insurance companies. Mutual insurance companies other than mutual life and mutual marine companies such as mutual fire, employers liability, worksman compensation, and casualty insurance companies which require their members to make premium deposits to provide for losses and expenses are allowed to deduct from gross income. 1. Any portion of the premium deposit returned to the policy holders. Second rule, such portion of the premium deposit as are retained for the payments of losses, expenses, and reassurance services. You can see it in section 37B, IRC section 27, section 127. Mutual marine insurance companies required to include in their return of gross income the gross premiums collected and received by them less amounts paid for reinsurance are entitled to deduct from gross income. Rule 1, amount repaid to the policyholders on account of premiums previously paid by them, and interest paid upon those amounts between the ascertainment date and the date of its payment. You can see it in section 37C and IRC section 128.
Assessment insurance companies. To define, this is an insurer retaining the right to assess additional charges above initial premium when those premiums are shown to be inadequate to cover the cost of operation. The general rules is whether domestic or foreign may deduct in a taxable year the sum actually deposited with the officers of the government of the Philippines pursuant to law. As additions to guarantee or reserve funds shall be treated as payments required by law to reserve funds. Estates and trusts. To define, trusts and estates are two of the primary legal structures used to transfer assets over to heirs and beneficiary after someone dies. So, the general rules is estates and trusts, which may avail of itemized deductions, can deduct from gross income any amount of income paid, credited, or to be distributed by beneficiaries. This income shall be taxable to the beneficiaries. Private educational institutions. The general rules are expenses allowable as deductions under Chapter 7. A private educational institution referred to under Section 27B of this code may at its option elect either to deduct expenditures otherwise considered as a capital outlays of depreciable assets incurred during the taxable year for the expansion of school facilities, to deduct allowance for depreciation thereof under subsection F hereof.
Items not deductible.
The general rule is that these expenses are not deductible in computing taxable net income. First, we have here personal, living, or family expenses. Second, any amounts paid out for new buildings or for permanent improvements or betterments made to increase the value of any property or estate. Third is any amount expended in restoring property or in making good the exhaustion thereof for which an allowance is or has been made. Fourth, premiums paid on any life insurance policy covering the life of any officer or employee or of any person financially interested in any trade or business carried on by the taxpayer, individual or corporate, when the taxpayer is directly or indirectly a beneficiary under such policy. And last is the losses from sales or exchanges of property between the related taxpayers. Capital expenditures. These are expenditures that result in obtaining benefits of a permanent nature, such as lands, buildings, and machineries. No deduction from gross income may be made. First is for new buildings, or second for permanent improvements or betterments made to increase the value or quality of the taxpayer's property, or third for any amount expended in restoring property or making good exhaustion for which an allowance for depreciation or depletion or other allowance is or has been made. Numbers 1 and 2 do not apply to intangible drilling and development costs incurred in petroleum operations, which are deductible under Section 34 G1 of the Tax Code. In the book, there are 11 examples of capital expenditures. So first, we have here cost of defending or perfecting title to property. Second, architect fees. Third, commissions paid in selling securities. Fourth, expenses of the administration of an estate, such as court costs, attorney's fees, and executor's commission, which are chargeable against corpus of the state. Fifth, we have, in the case of a corporation, expenses for organizations such as corporation fees, attorney's fees, and accountant's charges, which are ordinarily capital expenditures. Sixth is we have commissions paid in acquiring property as they represent part of the cost of the property acquired, and so on.
So let's go to premiums and life insurance of employees or officers. Any amount paid for premiums on any life insurance policy covering the life of an officer or employee or of any person financially interested in the business of the taxpayer when the taxpayer is indirectly or directly a beneficiary under such policy is not deductible. A person is said to be financially interested in the taxpayer's business if he is the stockholder thereof or he is to receive as his compensation a share of the property of the business. This means that the premiums paid by a taxpayer on any life insurance policy covering the life of an officer, employee, or any person financially interested in the taxpayer's business are not deductible. A person is considered to be financially interested if they are a stockholder of the business or receive a share of the property of the business as compensation. Here are the illustrations. In the first illustration, this means that the premiums paid by the corporation on the life insurance policy covering the life of its president with his wife as beneficiary are not deductible because the corporation is indirectly the beneficiary under the policy. This is because if the president dies, the beneficiary, his wife, will receive the aids of the policy, which will be used to benefit the corporation. In the second illustration, this means that the premiums paid by the corporation of the insurance of the lives of its officers are deductible because all members of the families of the employees are the beneficiaries. This is because the proceeds of the policy will not just go to the corporation itself, but to the families of the employees. Losses from sales or exchanges of property. No deduction is allowed in respect of losses from sales or exchanges of property, directly or indirectly, between members of a family, brothers and sisters, spouses, ancestors, and lineal descendants, or except in the case of distribution and liquidation, between an individual and a corporation more than 50% in value of the outstanding stock of which is owned directly or indirectly by or for such individual. Except in the case of distributions and liquidation between two corporations, more than 50% in value of the outstanding stock of each of which is owned, directly or indirectly, by or for the same individual, if either one of such corporations with respect to the taxable year of the corporation preceding the date of the sale or exchange was, under the law applicable to such taxable year, a personal holding company or a foreign personal holding company, or between the grantor and a fiduciary of a trust. Between the fiduciary of a trust and the fiduciary of another trust, if the same person is a grantor with respect to each trust, or between a fiduciary of a trust and a beneficiary of such trust, based from the previous slides, the purpose behind item 1 is the prevention of simulated or sham sales or exchanges by persons who are members of a family to avoid payment of income tax. It is immaterial whether the transactions are bona fide or not. The losses therefrom are not deductible, but the gains realized are taxable. In the case of items 2 to 6, the law presumes the absence of free bargaining between the seller and buyer. Thus, tax evasion or tax avoidance schemes are minimized. Item 3 still speaks of a personal holding company. Executive Order Number 37 repealed the provisions imposing a tax on personal holding companies.
Anagar. Guys, madunggan ako guys.
Tungan na, Benz.
Okay. Unsaon na siya pag kuan bitaw kanang pag-stop sa record ba? Asa na siya makita dahil masave ni iya? Wala pa binako gi-stop kay basig kuan mo.
Naara yata na sa chat na to. Group ni GC sa kami. sa kanitins.
So ako ni ikuha ning